That's what we're going to learn in chapter 4, process costing, which you can see in the slide. So first, there's plenty of similarities between job order and process costing. Both systems are going to assign material, labor, and overhead costs to products, and they give us a mechanism to compute the unit product cost. Both systems are going to use the same types of accounts, okay, which include manufacturing overhead, which we call MO, raw materials, work in process, which we refer to as WIP, and finished goods. So remember that materials, WIP, and finished goods are all types of inventory, okay? Which are in your balance sheet and as part of your assets. But it's just, remember that MO, it's just a bucket and a bridge account, which you have to zero it at the end of the year. So, or at the end of the period. So the flow of costs through the manufacturing accounts is basically the same in both systems, okay? So that's not so different, but obviously it has its particularities. In job order costing, we're going to find that we have many different jobs worked on each period, and each job is going to be somewhat unique in terms of its production requirements. Nothing new for you guys. We accumulate costs by job, and our unit costs are computed by job on a job cost sheet. Remember? Obviously, that's on a system. Everything is done in a system. But in contrast, process costing, we have a single product produced either on a continuous basis or at least for long periods of time. So in large batches, for example, all units of product are identical. Costs are accumulated by a department rather than a job, as we saw in job order costing, and unit costs are computed by department. That's the difference. In a process unit costing system, you need to be aware of what department is, and that's any unit in the organization where materials, labor, or overhead are added to the product, and the activities in a department are performed uniformly. So all units that go in receive the same treatment, and it's performed uniformly on those units. The output of a processing department must be homogeneous. So all of the units going out of a department must be the same. And products in a process costing environment typically flow in a sequence from one department to another. So let's think of some examples of when we might use process costing.
Well, you make the bottles for the shampoos. You want to produce lots of bottles. You gotta get the cost of one bottle of shampoo.
Exactly. So if we think in serial and we think about departments, we might have one department where we'll call it department A, and its output is just plain old, I don't know, what do you like? Sucaritas. And some of these sucaritas might go straight to the department D for packaging and shipping. But some of the output of the department could be routed to the department B, where they might receive honey, nut coating, and maybe become honey nut sucaritas. And they could go to the department D for packaging and shipping, or they can go from A to the department C, and they could receive, I don't know, what cereals do you like? Apple cinnamon coating. And all of the units to come out of department C could be homogeneous apple, cinnamon, sucaritas. And okay, it's not that we can only make one product, it's that we need to have a sequence and the output of any one department, it's going to be homogeneous. So all of the units that came out of the department were playing Cheerios, where they went from the not Cheerios, Sucaritas. I'm thinking in another cereal. So all of the units that came out of Department B were honey nut Sucaritas, and everything that came out of Department C was apple cinnamon Sucaritas, and then everything else ended up going through Department D for packaging and shipping. Okay, so we'll learn how we are going to apply cost as the Sucaritas pass through those departments. As we go here in the learning objective 1, so it's our first learning objective is to record the flow of materials, labor, and overhead through a process costing system. So it should look kind of like this. So we're looking, so we're going to take our direct materials, direct labor, and mow, and they'll go into our working process. Oh, so that's not new, right? We've looked at this model before in job order costing. And then we would apply each of its job, so job order costing system trace, and apply manufacturing cost to jobs when it's done. Then it goes to finished goods, and then it gets sold. So if we're looking at it in a process costing environment, like this, then our costs are going to be traced and applied to departments. So direct materials, direct labor, and mow will be applied into the departments. Then when it's done, they will pass to the finished goods, and then it gets sold. So a lot of similarities in here. So we are going to look at our flow of costs. So we're looking at 2 processing departments, which we will call creatively Department A and Department B. So we will use our T accounts. Remember T accounts, guys? So if we've got raw materials, which would start with a debit balance, we then would requisition materials into use, some for Department A and some for Department B. So when we requisition those materials, it would be a debit to WIP, Department A, and a debit to it will be a debit to Department B and credit to raw materials for the sum. Okay. Now keep in mind that direct materials is not an account title. It's a description of what we're doing. So the account title that we're using was WIP, work in process, for Department A and for Department B. So as in job order costing system, materials are drawn from the storeroom using a material requisition form. Again, it doesn't matter if that's paper, computerized, but some form materials requisition materials can be added in any processing department. So this would be our journal entry that we were just discussing. So we are using raw materials to processing departments. And Department A, Department B, so debit WIP, Department A, and credit raw materials for the total. So now we take a look at labor. So as workers are doing their work, we would be incurring in labor costs. And again, direct labor is not an account title, but just a description of what's going on here. So we're going to be debiting WIP A for direct labor and debiting Department B for direct labor. And we credit salaries and wages payable, unless it tells you that to credit cash, but for now we'll stick with the payable. So in process costing, labor costs are traced to departments, not individual jobs. The following journal entry records the labor to the Department A and we debit obviously WIP department A, WIP department B, and credit salaries and wages. So let's see. So in process costing, as in job order costing, manufacturing overhead cost is applied according to the amount of the allocation base that it's incurred in the department. So we will apply it as the same as for department A, department B, and credit MO according to the allocation based or incurred in the department. So, and then when we finish our work in department A, it then gets transferred to the department B. So remember, we have a flow. So we need to be able to picture that flowing of our work through our company. So it goes from department A to department B, and then from department B, we'll probably finish it. And so we're looking at the transferred in costs from department A are added to the manufacturing cost incurred in department B. So when it's all done in department A, we move it to department B with debit to the WIP in department B and credit to the WIP of department A. Again, here's the same thing in the journal entry form. We're debiting with department B, it's going up, and we're crediting with department A, it's going down. So assuming that we finish the good in our final department, and now the product is complete, we're then going to transfer it from WIP department to B to finish goods. Remember that we transfer when we finish the product that it's cost of goods sold manufactured. Cost per sorry, not cost of goods sold. It's cost of goods manufactured. So again, that's not an account title, that's a description of what's happening. So we're debiting finished goods, and it goes up, and we're crediting department B, which is going down. So here's the same thing in the journal entry form. After processing has been finished in department B, the cost of completed units are then transferred to finished goods inventory. And finally, what do you think it will happen? Of course, we sell the product. Then it is no longer finished goods inventory. It has to move to cost of goods sold, and it gets expense on the income statement. So that's a debit to cost of goods sold or COGS, and credit finished goods. Nothing new. Finally, when a customer orders fill and units are sold, the cost of the units is transferred to cost of goods sold. Now, here it's showing exactly what we just discussed in journal entry form, but they kind of ignore the sales part of this entry. We would be doing this in a conjunction with recording the sale. Remember, there is the matching principle, okay? And there will be relief that inventory in part B, and part B is what we're looking at. So they've kind of ignored part A, but part B is where we remove it from inventory and we expense it to COGS. That's a debit to COGS and credit to finished goods inventory, of course. A few key concepts that we need to understand with process costing. So in process costing, each department needs to calculate two numbers for reporting purposes. One is the cost of its ending with, then it's also the cost of its completed units that we're transferred to the next stage. And that next stage could be another department, or it could be to finish goods inventory. So in doing that, there's two different methods for performing those computations. The first being the weighted average method. The weighted average method, guys, process costing calculates units by combining costs and outputs from the current and prior periods. And another method, it's the FIFO method of process costing, which will be covered in later on, and calculates units costs based solely on the cost and outputs from the current period. Okay, weighted average method and the FIFO method. So do you have heard the FIFO method? Well, I can tell you our characteristics of the weighted average method would be that this method makes no distinction between work done in prior or current periods. It's just an average. An average equivalent units of production that it doesn't matter if you increased costs in none of the periods. Like, it just gives you an average, and you don't need to like differentiate first in, first out, and first out, first in.
The inventory?
Yeah.
Primeras entradas, primera salida?
Exactly.
Yes.
And what is that? And why would you use an average cost for the units to pass to each department? There is a key concept that I need to explain you, which is conversion cost. That it means that direct labor costs are often small in comparison. How do you say comparison?
Comparison.
Exactly, to other product costs in process costs. So remember that they are small, so they become like conversion costs, which means that direct labor and MO are often combined into one classification of product cost called conversion cost. Let me try to give you an example. Let's think that we started with 50,000 units and for the current period, and we completed 10,000 units. So we have, like, for this period, we have 50,000 units of whatever you want. No worries about the product. So, and we have completed 10,000 units, okay? Completed, let's put it C for completed, and leaving 5,000, obviously, 5,000 units in process, like 30% complete, no? So how many equivalent units of production we will have for this period? Remember that there is 30% of completed. So let's start with the ones, the units that we don't know, and then we can add up the partially completed units. So we have 10 units that are for sure completed units, and then we have 5,000 units that are 30% complete, meaning 5,000 times 30%, it is 1,500, giving a total of 11,500 equivalent units for the period. So this is an important concept, equivalent units, because we will learn how to compute the equivalent units of production using the weighted average method. What does it mean? It's like equivalent units are the products of the number that are partially completed units and the percentage of completion of those units with respect to the processing in the department. The equivalent units is the number of complete units that could have been obtained from the materials and efforts that went into the partially completed units. Equivalent units is the number of complete units that could have been obtained from the materials and efforts that went into the partially completed units.
The 5,000 in this case symbolizes the ones that are being produced, right?
Exactly.
Then, and they are 30% completed.
Exactly.
So if instead we would have used the materials of the ones of the 1,500, that symbolizes the units we could have produced with the same materials.
Exactly.
Okay.
Exactly. Equivalent units need to be calculated because a department usually has some partially completed units.
Mm-hmm.
Okay. What do you think it means? The thing is that I watch it in my head because I don't know if you remember that I worked for Colgate Palmolive. That was my first internship. So imagine that you have all the tubes, the paste tubes,
Mm-hmm.
and suddenly you need to stop the production line for whatever reason. It could be like quality reasons. You overpass the job orders. Well, not the job orders, like the demand. You overproduced. So equivalent units need to be calculated because a department usually has some partially completed units in its beginning and in the inventories. Okay? These partially completed units complicate the determination of a department's output for a given period. That's the difficult part. And the unit cost that that will be assigned to that output.
Yeah, that the equivalent units are what you would have been able to produce if the production hadn't stopped based on the units that you have already produced.
And why do we use that? Because departments usually have some partially completed units in its beginning and ending inventories. So these partially completed units complicate the determination of a department's output for a given period. And what does it mean? That the unit cost that you will assign to that output, it's not that easy because you're not always going to produce like 10,000 toothpaste, 10,000. No, it's not like that. So you need to learn the concept of equivalent units because it's a product of the number of partially completed units and the percentage of the completion of those units. Okay?